PennantPark Floating Rate Capital. Ooh, what a mouthful. And no, this company has nothing to do with baseball. This is actually a business development company, or a BDC, that was founded in 2007 with the goal of providing capital to the core middle market companies. Now, these are companies that typically generate between $10 million to $50 million in annual EBITDA. These are not going to be household names, so you're probably not going to recognize them because they're actually a little bit too large for traditional small business financing, but they're too small to attract attention from the major big banks. Now, this becomes an unrepresented space that allows BDCs like PFLT to find high yield investment opportunities with limited direct competition from the big, larger financial institutions. Now, what exactly are BDCs? You guys know that I've covered this before on this channel, but BDCs, I think, are some of the most underrated industries in the stock market that give super high, juicy yields. Now, BDCs, they are business development companies, and this is a type of closed-ended investment company created by Congress in 1980 to enhance capital access for small and mid-sized businesses. More specifically, BDCs invest in privately held or thinly traded public companies by providing debt and other equity capital. Now, by rule, they must distribute at least 90% of taxable income to their shareholders. This is very similar to those who own REITs. They follow a similar structure, and now this often results in higher yields, high dividend yields for the investors. The reason this happens is because BDCs, they avoid paying corporate income taxes if they give out at least 90% of taxable income to shareholders. So they avoid paying corporate taxes, but then this allows for more money to flow to the shareholders. Now, they are typically traded on public exchanges. That's why PFLT is available for us to invest in, and it offers the retail investor access to this private credit market. All right, so what are some of the key highlights and strategy of PFLT? So the target market that PFLT is going to focus on is the core middle market. This offers debt financing to companies that fall between the traditional small and large business spectrum. These businesses are often overlooked by the large banks, but they still need to operate, right? These companies still need money, and that requires flexibility and tailored lending solutions. So let's take a look at some of the sectors that they are lending to. So they have 5 key industries of expertise, and these are all pretty recession resilient. So even during bad times, these companies should be paying back their loans. This includes sectors such as healthcare. This includes government services. The government has endless amounts of money. Software and technology, consumer services, business services. So these are all needed for day-to-day activity to happen. We can see here, these are not just fads, they're always going to be existing. And PFLT has a global footprint. They actually operate out of key financial hubs around the world. This includes New York, Miami, Chicago, Houston, and even internationally in Amsterdam. This gives access to a wide geographic spread. And another thing I love about BDCs is that we're giving our hard-earned money to an experienced team of investors who are doing all the work for us. And PFLT is no different. Their senior investment team has on average over 26 years of industry experience. They provide the strong underwriting capabilities and the deep industry relationships needed for a company like this to thrive. And they also have a really good track record. Since its inception, PFLT has deployed over $20 billion in capital, and this reflects a strong historical capacity to originate and manage a large portfolio of investments. When we talk about those investments, let's take a look at some of those characteristics. So the loan structure, they're primarily going to be investing in first lien senior secured debt. This means they are first in line to be repaid in case of borrower distress or liquidation. That is awesome. So of course it's going to be risky to be lending out money, but they are going to be first in line to get those assets in case the company goes bankrupt. They also have loan durations that typically range from 3 to 10 years, so that offers a mix of medium-term investment stability and turnover. In regards to the variable interest rates, and interest rates are definitely going to be external factor that impacts BDCs for sure. But PFLT's loans are floating rate, meaning that returns are going to get adjusted with changes in benchmark interest rates. Now, this also protects against interest rate risk and allows the company to maintain yields in rising rate environments. Now, in terms of the average investment metrics, each investment is typically around $8 million. So again, not too big, not too small. And the average yield that the company gets is approximately 12.6%. So again, this reflects the high risk, high reward nature of lending to non-investment grade companies. Sure, you're getting a high yield, you're getting a high return, but there's a potential that the company might not pay you back. Now, when companies don't pay you back, that becomes known as a non-accrual investment. These are loans where interest payments are no longer expected. It's very similar to if you owned real estate and the tenant no longer pays rent. PFLT's non-accrual rate is just 0.9% of total investments. That indicates they have a strong credit performance and disciplined underwriting. In terms of funding and their growth strategy, so they're going to be having debt offerings. So PFLT raises capital through debt offerings, which are then deployed into new investments. They also reinvest principal repayments into new loans. This provides a consistent stream of long-term funding for portfolio growth. They also partner with other sponsors. Many deals involve financial sponsors or private equity firms, which adds a layer of due diligence and credibility to investment decisions. They also have sponsor-backed companies that often have better governance, a clearer growth or exit strategy. Regarding that exit opportunity, PFLT seeks investment with clear paths to liquidity, such as refinancing their loans, strategic acquisitions, and of course the legendary IPOs or initial public offerings. This is a company that also focuses on free cash flow, so they target companies that must demonstrate the ability to generate free cash flow, ensuring they can service debt obligations. Now, what are some of the risks and challenges? Well, again, high yield often comes with high risk. Loans are inherently risky. There's no guarantee of repayment, but truly, I do think the premium yields compensate for this elevated level of risk. These days, you're now getting close to a 13% yield on PennantPark floating rate capital stock. That is pretty impressive. One of the downsides too is also just limited control. As a lender, it has a limited operational control over its portfolio of companies. So if an activist investor or changes in management occur, it could really alter the company's trajectory, and PFLT really doesn't have a big say in it. There's also the dependence on advisors. So if the company heavily relies on its external investment advisor, if key personnel leave, it could disrupt deal sourcing and portfolio management. So everything I said previously about having a great experienced team, unfortunately, turnover happens. People change jobs, and that could impact the future of this company. There's also, of course, the interest rate risk. Although floating rates help during rising rates, sharp rate declines can hurt income unless hedging or other mechanisms are in place. So most of us anticipate that the Federal Reserve will cut interest rates in the future, so just keep those external factors in mind. In terms of how their portfolio growth has went in the past, the portfolio has grown 11% year over year, reaching a market value of $2.2 billion. And then, of course, what you really want to know about is their dividend history. So in addition to this super juicy yield of nearly 13%, they've also paid monthly dividends every single month since their IPO in 2011. So we can see here, they just consistently keep paying dividends. There hasn't been too much dividend growth over the years, but when you're getting nearly a 13% yield every single year, I don't think you're going to mind too much. What's also super impressive is that they continued paying dividends during the 2020 forced shutdowns. To me, this signals a company that's resilient and has a really strong management team that they can continue to pay dividends even during bad times. This is just their dividend yield over time. You can see since 2015, they've consistently been well over 7%. And guess what a great buying opportunity presented itself. During the height of the coronavirus, PFLT was giving out a ridiculous yield. What is this, 25% yield? Can you imagine getting your money back every 4 years? Absolutely insane. It has slowed down since then, but guess what? It's went back up in recent times because of all this tariff talk. So this could potentially represent a great buying opportunity. I have a feeling in a couple months we'll actually realize that the actual company fundamentals did not change, and this is still a great company to potentially get in at these super high juicy yields. So who is PFLT for? This is for somebody who wants monthly passive income in the form of dividends that PFLT gives out loans to. When they repay those loans, that comes to the shareholders in the form of dividends. If you want to start earning a small stream of income while you sleep, PFLT could certainly be one way to do it. Remember, we're all trying to build that dividend snowball. Reinvesting these monthly payouts can slowly grow your portfolio over time. This is also for somebody who's comfortable with some risk for some higher reward. These aren't as safe as, say, government bonds or blue chip stocks, but PFLT lends to companies that the big banks usually pass on. So there's going to be a little bit more risk, but also, again, more reward. The average loan yields well over 12%, which is a lot more than what you get from a savings account or treasury bonds. But again, it's like giving money to somebody who doesn't have perfect credit. They might pay you more, but you're taking a chance that they might not be able to pay you back. And again, I just love the diversification that is in the stock market, right? This is what I would consider private lending or an alternative investment. You get exposure to the private credit market, which is usually only accessible to the big institutions or high net worth individuals. But with PFLT, we are getting exposure to something that only the rich have access to. It's also a chance to diversify beyond just stocks and ETFs and learn a little bit more about how private lending works in the real world. And there's really not going to be much capital appreciation here. Really, the only way to grow that wealth is through the dividends. This is really just a slow and steady way to go up, or even just stagnant. And this probably isn't for somebody who needs money right now. Really, these BDCs, they're better suited for the long-term investor. And just keep in mind, dividends from BDCs like PFLT, they're generally taxable as ordinary income. So it's going to be on your highest income bracket. It's not going to really be much tax benefits to this. I really want to thank my Discord member Conspira for the recommendation, for pointing this stock out to me. Just let me know in the comments if you guys ever want me to cover a particular stock. Make sure you're also joining the Discord. We have some great conversations in there, and it is free. It's a way to talk with other like-minded investors who are probably on the same investing journey as you. If you want to see my full $200,000 plus portfolio that I was able to make in my 20s and also beat the market, make sure you check out the Patreon link below and hit that like button on your way out as we slay the dragon together.
If I'm getting margin call at the lowest point, I'm not surviving this thing. I'm going to get margin call every week. Every week.